So imagine for a second that you've just walked into your local bank. You're feeling responsible, maybe even a little proud of yourself as you hand over $1,000,001, roughly $750, to put into a standard savings account. The clerk smiles, gives you a crisp receipt, and promises you a whopping 2% annual interest. Fast forward a year, and what do you have? You've gained about 20,001. Congratulations. You've earned enough for a decent fried chicken dinner and maybe a side of pickled radishes. But here is the cold, hard truth that the bank won't tell you. While your balance grew by 2%, the price of that same chicken probably went up by 5%. In the world of real economics, you didn't save money. You paid for the privilege of letting the bank use your capital while your purchasing power slowly evaporated. Oh, it's a rigged game, isn't it? We are taught from childhood that saving is the ultimate virtue, but in an era of relentless inflation and debt-driven economies, traditional saving is often just a slow-motion leak in your financial ship. Well, now you might think the only alternative is to dive headfirst into the shark-infested waters of the stock market, picking individual companies and praying that the next CEO scandal doesn't wipe out your life savings. You've seen the movies. You think you need to be a Wolf of Wall Street, staring at 6 monitors and shouting into a telephone. But what if I told you there's a middle path? A way to capture the growth of the greatest companies on earth without the heart-stopping risk of putting all your eggs in one fragile corporate basket. This is where the ETF, or exchange-traded fund, enters the chat. Think of it as the ultimate cheat code for the modern investor. While most people hear the acronym and their eyes glaze over, thinking it's some complex derivative cooked up by math PhDs in a basement, it's actually beautifully simple. To understand an ETF, stop thinking about spreadsheets and start thinking about a luxury fruit basket. If you go to a market and buy just one apple, and that apple happens to be rotten inside, your entire snack is ruined. That is individual stock picking. But an ETF is like buying a prepackaged high-end gift basket. It's got 3 apples, 2 pears, a bunch of grapes, and 5 oranges. If one grape is sour, who cares? You've still got the rest of the basket to enjoy. In the financial world, those fruits are shares of companies like Samsung, Apple, or Nvidia. Instead of trying to guess which single company will win the decade, you're essentially buying the entire podium. But here is the real kicker. How does this even exist? How can you own a tiny piece of 500 different companies for the price of a pair of sneakers? It happens because of the titans of Wall Street, firms like BlackRock and Vanguard. These are the leviathans of the financial ecosystem, managing trillions, yes, trillions with a T, of dollars. Well, they go out and buy millions of shares of every major company in existence. Then they slice that massive pile of ownership into billions of tiny, affordable pieces and sell them to people like you and me. It's like a massive restaurant buffet where you pay one entry fee and get a plate that holds a bite of everything from the sushi bar to the dessert table. You aren't betting on the chef's special, you're betting on the success of the entire kitchen. Now you might be wondering, if it's this easy, why isn't everyone a millionaire? Oh well, because the market isn't a straight line up. It's a chaotic, emotional, and often irrational beast. But before we get into the how of making your first 200 million won, we need to look at the legendary heavyweights that actually run the show. Now let's talk about the titans, the real heavyweights of the investment world. If you've spent any time on financial social media, you've likely heard names like SPY or QQQ tossed around like they're holy relics. And in a way, they are. These are index ETFs, and they represent the philosophy of buying the haystack rather than searching for the needle. The late John Bogle, the founder of Vanguard and a man who revolutionized the way regular people build wealth, once argued that trying to beat the market is a fool's errand for 99% of humanity. Even the most sophisticated hedge fund managers, with their supercomputers and Ivy League degrees, often fail to outperform the simple S&P 500 over a 10-year period. It's a humbling reality, but for us, it's a massive opportunity. Let's dissect the legendary SPY first. This ETF tracks the S&P 500, which is essentially a list of the 500 largest, most successful publicly traded companies in the United States. Think about that for a second. When you buy one share of SPY, you are instantly becoming a part owner of Apple, Microsoft, Amazon, Google, and Berkshire Hathaway, along with 495 other corporate giants. These companies are the backbone of the global economy. They own the satellites in space, the software on your desk, and the logistics networks that deliver your packages. But here is the genius of its design. It is market cap weighted. While this means the bigger and more successful a company is, the more of it you own within the ETF. Nvidia, currently the darling of the AI revolution, might make up about 6 or 7% of the fund, while a smaller struggling retail chain might make up only 0.01%. It's a self-cleansing mechanism. If a company fails or shrinks, it naturally falls out of the index, and a new rising star takes its place. Yet you are essentially betting on a team that automatically fires its worst players and hires the best ones. But here's the real kicker. Most people think that because an index fund is safe, it must be boring. But let's look at the cold, hard numbers. Historically, the S&P 500 has returned an average of about 10% per year over the last century. And now 10% might not sound like get-rich-quick money, but in the world of compound interest, 10% is a chainsaw. If you had invested $100 back in 1980 into an S&P 500 index and just walked away, you'd be looking at a return of over 17,000% today. We aren't talking about doubling your money. We are talking about a total transformation of your financial DNA. All, of course, if the S&P 500 is the reliable sedan of the investing world, then the QQQ is the turbocharged electric supercar. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ exchange. Dad, this is where the tech giants live. If you believe that the future of humanity belongs to artificial intelligence, biotechnology, and the cloud, then QQQ is your vehicle. Yeah, and it is more concentrated, more aggressive, and frankly, a bit of a wilder ride. While the S&P 500 gives you exposure to boring stuff like banks and oil companies, QQQ is almost entirely focused on innovation. And during the tech boom of 2023, while the broader market was doing okay, QQQ was up over 50%. But, and this is a big but that many influencers tend to skip over, volatility is the tax you pay for those high returns. Why, in 2022, when interest rates started climbing and the tech world panicked, QQQ didn't just dip, it plummeted by about 33%. Imagine looking at your 100 million won and seeing it turn into 67 million in the span of a few months. And that is the moment where most people fail. They see the red numbers, their heart rate spikes, and they sell at the bottom, locking in their losses. All the smart friend advice here is simple. If you can't stomach the sight of a 30% drop, stay away from the NASDAQ and stick to the broader S&P 500. You see, the market is like a pendulum. It swings between extreme optimism and total despair. The secret to that 200 million won target isn't finding a secret stock. It's having the psychological fortitude to stay in the game when everyone else is running for the exits. But what if you want to be more specific? What if you want to bet on a specific flavor of the economy or protect yourself when the tech bubble finally pops? While buying the entire market is a fantastic foundational strategy, some of you might be thinking, look, I know tech is going to eat the world, or I'm worried about the aging population. This is where we move from the shotgun approach to the sniper rifle, sector ETFs. If the S&P 500 is the entire mall, a sector ETF is a specialized boutique that only sells one type of product. Let's talk about XLK, the Technology Select Sector SPDR Fund. If you think the current AI hype is just the tip of the iceberg, this is where you want to look. It's even more concentrated than QQQ, focusing almost exclusively on the software and hardware giants. Think of companies like Microsoft, Nvidia, and Apple. Over the last decade, XLK has turned early investors into very wealthy individuals, growing nearly six-fold. Why? Because we've shifted from a world of physical assets to a world of bits and data. 10 years ago, you hailed a taxi on the street. Now you use Uber. You used to go to a cinema. Now you have Netflix. You used to ask a librarian. Now you ask ChatGPT. XLK isn't just a bet on computers. It's a bet on the fundamental restructuring of human civilization. But tech isn't the only game in town. Consider XLV, the healthcare sector ETF. This is the demographic destiny play. Whether the economy is booming or crashing, people still get sick. They still need surgery, and they still need their prescriptions. As the global population ages, especially in places like South Korea, Japan, and Western Europe, the demand for healthcare services is mathematically guaranteed to rise. XLV holds the giants like Johnson & Johnson, Pfizer, and United Health. The beautiful thing about healthcare is its defensive nature. During the 2008 financial crisis, when banks were collapsing and people were stopping their luxury vacations, they didn't stop buying their insulin. Investing in healthcare is like buying a ticket to a show that everyone is forced to attend eventually. But here is the real kicker. What happens when the entire stock market decides to take a nosedive? Even the best tech and healthcare stocks can get dragged down in a panic. This is where you need the insurance policy, otherwise known as commodities and bonds. Let's look at GLD, the gold ETF. Gold is a strange beast. It doesn't pay a dividend, it doesn't grow, and it doesn't innovate. It just sits there looking shiny. In the eyes of a pure growth investor, it's a dead asset. But in the eyes of a historian, gold is the ultimate survivor. Whenever the real economy looks like it's about to catch fire, due to war, hyperinflation, or a global pandemic, investors run to gold like it's a bunker. And in 2008, while stocks were losing half their value, gold was actually gaining ground. It's a bet against human stupidity and systemic failure. Keeping about 5 to 10% of your portfolio in GLD is like paying for car insurance. You hope you never have to use it, but when the crash happens, you'll be incredibly glad you have it. And then we have AGG, the aggregate bond ETF. If stocks are the engine of your car, bonds are the airbags. A bond is simply a debt instrument. You are essentially becoming the bank and lending money to the government or a large corporation. In return, they pay you a fixed interest rate. AGG tracks the broad U.S. investment-grade bond market. Bonds and stocks often have an inverse relationship. When the stock market gets too scary, big institutional investors pull their money out of risky tech stocks and park it in safe government bonds. This flight to quality often causes bond prices to rise exactly when your stocks are falling. Oh, this is the secret to the famous 60-40 portfolio. 60% stocks for growth, 40% bonds for stability. It might not be the most exciting way to invest, but it's the way you ensure you don't wake up one morning to find your net worth has evaporated. However, there is a darker side to the ETF world, a side where the potential for profit is massive, but the potential for total ruin is just as high. It's the siren song that lures in many beginner investors, only to leave them shipwrecked. Now we need to have a serious talk about the dark alleyways of the ETF world. If you go on any investment forum today, you'll see people bragging about triple-digit gains in a matter of weeks. They aren't buying the boring S&P 500, they are playing with fire. And they are buying leveraged and inverse ETFs. Imagine the NASDAQ 100, already a high-performance index, and then imagine straping 3 rocket engines to it. That is TQQQ. If the NASDAQ goes up 1%, TQQQ goes up 3%. It sounds like a dream, right? Why settle for 10% a year when you could theoretically get 30? But here is the real kicker, and this is where most retail investors lose their shirts: the math of volatility decay. Leveraged ETFs are designed for daily trading, not for holding. Let's say the market is volatile. On Monday, the index goes up 10%. On Tuesday, it drops 10%. In a normal world, you'd think you're back to where you started, right? Not quite. A $100 investment goes to $110, then drops to $99. You lost 1%. But in a 3x leveraged fund, that 10% gain becomes 30%. $130, and that 10% loss becomes a 30% drop from that new high. Suddenly, your $130 is down to $91. The index only lost 1%, but you just lost 9% of your capital. This is why leveraged funds are often called widowmakers. They are a siren song, beautiful from a distance, but they will pull your portfolio into the abyss if you stay too long. So if the fast way is actually a trap, how do we get to that 200 million won target? We use the only real magic that exists in finance, the miracle of compounding. Albert Einstein supposedly called compound interest the 8th wonder of the world, saying, "He who understands it, earns it. He who doesn't, pays it." Let's run the numbers, and I want you to really visualize this. Well, suppose you decide to skip a few expensive coffees or a couple of delivery meals and put just 100,000 won, roughly $75, into a broad index ETF like SPY every single month. In the first year, you've saved 1.2 million won. And you look at your account and think, this is nothing. Why am I even doing this? This is the valley of disappointment, where most people quit. But let's keep going. Using the historical average return of 10%, after 20 years of consistently putting in that 100,000 won, you will have deposited a total of 24 million won. But your account balance won't be 24 million. It will be approximately 76 million won. What, you've more than tripled your money just by being consistent. But wait, here is where it gets crazy. If you leave that money for another 10 years, making it a 30-year journey, your total deposits will be 36 million won. But the final balance? It balloons to over 220 million won. Think about that for a second. You put in 36 million, but you ended up with 220 million. The extra 184 million won didn't come from your hard work or your labor. It came from the 500 largest companies in America working for you while you slept. It came from the exponential growth of dividends being reinvested and the price of innovation climbing higher. This is the mathematical miracle. It doesn't require a high IQ or a fancy terminal. It only requires time and a stomach that doesn't churn when the news cycle gets scary. But before you go out and dump your life savings into an app, there are a few practical shackles you need to be aware of, specifically taxes, fees, and the psychological traps that the government and the market have laid out for you. Before you go off into the sunset with your vision of 220 million won, we need to talk about the friction of the real world. In physics, there is no such thing as a perpetual motion machine because of friction. In finance, that friction is composed of fees, taxes, and your own ego. Most investors ignore these 3 things until it's too late, and then they wonder why their actual bank balance doesn't match the fancy charts on their screen. First, let's talk about the silent killer, the expense ratio. Every ETF has a cost to run. The people at BlackRock and Vanguard don't work for free, after all. But there is a massive difference between a cheap fund and an expensive one. A titan like SPY has an expense ratio of about 0.09%. That is practically pennies. However, some specialized or actively managed ETFs might charge 1% or more. Now you might think, it's just 1%. What's the big deal? Here is the math. Over a 30-year investment horizon, a 1% fee can eat up nearly 1/3 of your total potential wealth. 1/3. That you are essentially giving away a massive chunk of your retirement just because you didn't check a tiny number on a fact sheet. The smart friend rule is simple. If you can get the same exposure for a lower fee, do it every single time. Then, there is the tax man. If you are investing in US ETFs from South Korea, you need to understand the 22% capital gains tax. The government gives you a small gift. The first 2.5 million won of your annual profit is tax-free. But every single one above that, Uncle Sam and the Korean tax office are taking 22%. Well, this is why you don't jump in and out of positions. Every time you sell to lock in a profit, you are triggering a tax event that slows down your compounding engine. Think of your portfolio like a tree. If you keep chopping off the branches to sell them, the tree never reaches its full height. And we cannot ignore the currency factor. When you buy a US ETF, you aren't just betting on the companies, you are betting on the US dollar. If the dollar is weak when you buy and strong when you sell, you win twice. If it's the other way around, your returns get squeezed. Yeah, but here is the cold, hard truth. Don't try to time the currency market. Professionals spend their entire lives failing to predict exchange rates. If you are investing for 20 or 30 years, the fluctuations in the $1 exchange rate tend to smooth out. Focus on the assets, not the currency fluctuations. Finally, let's talk about the most important rule of all. Never, under any circumstances, invest money that isn't yours. I see people taking out low-interest loans to dump into safe ETFs. It's a strategy called leverage, and it works brilliantly until it doesn't. But when the market drops 20%, and it will eventually, you aren't just losing your savings, you are still on the hook for that loan and the interest. That kind of pressure is what causes paper hands. It's what makes you sell at the absolute bottom because you can't afford to pay your rent. And the only way to win this marathon is to use patient capital, money you don't need for at least 5 to 10 years. So, here is your playbook. Start small, but start today. Set up an automatic transfer of 100,000 won into a broad index ETF like SPY or QQQ. Don't check the price every day. In fact, try not to check it more than once a quarter. Treat it like a utility bill, something you pay every month to ensure your future self has electricity and heat. The path to 200 million won isn't paved with genius-level insights or secret tips from a guru. It's paved with boredom, consistency, and a stubborn refusal to let the chaos of the world distract you from the math. You are no longer just a consumer in this economy. You are a part owner of the engines of progress. Act like it. Stay the course, ignore the noise, and let time do the heavy lifting. Your future self is already thanking you for the coffee you didn't buy today, and the ownership you did. Would you like me to create a simplified checklist for beginners that breaks down exactly which ticker symbols and account types to look for to get started?